Now, what is the put call parity? We talked about replicating portfolios or replications earlier in the first 2 weeks. Replication is when we have, let's suppose, an investment in an asset like A and another investment in C, and the risk and return of both these is the same. So if you invest in A, you end up having the same risk return trade-off, and if you invest in B, you end up having the same risk return trade-off. In derivatives, it is possible that you invest in A and B, that gives you the same risk and return trade-off as if you invest C and D. So whenever such a case is, when the risk and return are identical, then the investment or the prices of such portfolios should always be the same. If this portfolio can be constructed with lower investment than this portfolio, then there is arbitrage. What you can do, you can buy A and B and you can sell C and D and take advantage of the mispricing, as we learned how to do this for A and C in the first lecture. The put call parity says that buying a European call option and investing in the risk-free bond for time T should give you the same payoff as if you buy a European put option and buy the underlying share. So buying this side and buying this side have the same payoff. There is no chance that you will get a different outcome with this portfolio than this portfolio. So they are identical, they are the same. If they are identical, then it means that to buy one call and this investment, the amount needed should be exactly equal to the amount you need to buy one put option and the underlying stock here. If this is not the case, again, there is an arbitrage. If I look at this now, let's suppose today I have two portfolios, portfolio A and portfolio B. In portfolio A, I have a call option, a European call option at the underlying with an exercise price. And I have invested X into 1 plus R raised to the power minus T. So I have long positions in both of them. And then I have invested in a put option in portfolio B, where I have the put option plus the underlying asset, which is the stock. So this is also a long position and this is also a long position in both the constituents. At expiration, let's suppose in 1 year time, there are two possibilities. ST is equal to or less than, let's suppose 80, and ST is greater than 80, and ST is equal to, let's suppose 120. And we are assuming that exercise price is 100. If ST is 80 and I have the right to buy this share at 100, will I exercise my right to buy the share of this company for 100? No. I can buy it cheaper in the market for 80. So I will not exercise my right. So the option will expire out of the money. So there will be a zero payoff from it. However, what will happen? The investment in the risk-free bond will grow to its par value or face value, which is X. And let's suppose X is equal to 100. So my payoff here is X is equal to 100. What about portfolio B? I have the right to sell the share of this company for $100 and it is selling in the market for 80. So I will exercise my put option and I will sell the share for 80. So I will receive X, which will be 100, and then I will deliver the stock, which is worth ST. So ST is 80. And I already have the share with me, which was worth S0, and S0 is now worth ST, which is 80. So this crosses with this, and I am left with X is equal to 100. Portfolio A is paying me 100. Portfolio B is also paying me 100. If I come here, if this situation happens, what will happen? I have the right to buy the share of this company for $100 and it is selling in the market for 120. So I will exercise my right. So I will receive ST, the stock worth 120, and I will pay the exercise price, so X of 100. And the X that I need to pay here will come from the risk-free bond in which I have invested, so that will be 100. So X crosses with X and I am left with ST equal to 120. Portfolio B, if I can sell in the market for 120, why would I exercise my right and sell it for 100? So the put is out of the money, so that is expiring out of money, zero payoff. And S0 will be worth ST, which is equal to 120. So my payoff here is exactly the same as I got it from the first portfolio, portfolio A. So in no case it is possible for portfolio A or portfolio B to have a different payoff than the other. In such a case, when both the portfolios, either I form this portfolio or I form this portfolio, my payoff is fixed. I will receive either this or this. So when portfolios have identical payoffs, they should sell for the same price. And this is what is reflected here by the put call parity, where we are saying that buying a stock and buying a put on the same underlying will always have a value equal to a portfolio where we are long the call on the same underlying and where we have invested in the risk-free bond an amount equal to the present value of the exercise price. This is the most powerful expression you will get in finance, because what this is doing is giving you the ability to analyze at least three markets at the same time. One is the bond market, the other is the spot market for the equity, and the other is the derivative market and the call options and the put options. So if you want to know which one of them is overvalued or undervalued, whether the bond market or the stock market, you can identify. And that is where we come to the concept of synthetic securities. So what is a synthetic security? Synthetic security is basically a replication of an actual security. So we know that buying a put plus buying the stock is equal to buying a call and investing in the risk-free bond. So if I manipulate this equation, it means that if I want to buy a put and I want to replicate whatever payoff I can get with a put option here, I need to do what? I need to buy the call option, I need to invest in the risk-free bond, and if I short the stock, I will get the same payoff as if I have invested in a put option. So this is the synthetic security and this is the actual. If I want to replicate the payoffs of a stock, like if somebody buy a share and somebody creates, let's suppose Mr. A creates a portfolio where he has invested all his money in stock A, and Mr. B invest in the call option and the risk-free bond, and then he also shorts the stock. So the payoff Mr. A gets will be equal to the payoff Mr. B gets, because Mr. A is having investment in the actual stock and Mr. B is having investment in the synthetic stock. And because of the put call parity, the payoff of these portfolios will be the same. Similarly, if somebody wants to invest in the call option and another person wants to replicate, let me just write this all again. So we have the put option, so that will be equal to the call option plus investing in a risk-free bond and shorting the stock, and then the stock will be equal to buying the call plus investing in the risk-free bond, and then investing in the shorting the put option. And if somebody wants to buy the call option, that can be replicated by buying the put option plus buying the stock and shorting the risk-free bond. And if somebody wants to replicate the risk-free bond, so it can be done using a long position in the put option, a long position in the underlying, and a short position in the call option. So this is the synthetic bond. This one is the synthetic call. We're talking about this portion of it, okay? This portion. These are the actual. And then this one is the synthetic stock, and this one is the synthetic put. So this is a powerful expression. If you want to know which one of them is overvalued or undervalued, you look at the actual price of the stock in the market and you then create a portfolio like this. If this side is more than this, it means the stock in the actual market is undervalued, and this side of the equation is overvalued. So what you would do, you would buy the stock and then you would go short this side. That is, you would buy the stock and you would buy the put and you will sell the call and you will sell the bond. If this side is low and this side is high, so then what you would do, you would actually sell this side and buy this side of the. Now the principles of put call parity cannot be apply to American calls. For American calls, it will not hold that. There is an inequality of a put call parity that is there in the book, which is actually here written, but you see, even this cannot be proven. If you go to table 3.12, you can see that what is happening, that the value here is higher, then the value here is lower, then the value here is lower, but it's not always the case. So you can see 140.9, 139.59, and then you see this one is higher, 139.9. So though this expression that we have here is generally considered a good approximation, but when you apply it to real American calls or American puts, you will see that there will be some you can say deviations from this. The put call parity that we have discussed here is mostly applicable to European puts and call, and for the American we have this inequality, but this will not hold always, as we saw with the actual numbers.